All right. But what happened though? What happened though was monetary policy and fiscal policy came together. Paul Volcker went to Ronald Reagan. We have to remember Paul Volcker was appointed by Jimmy Carter. Paul Volcker said to Ronald Reagan, and Ronald Reagan agreed with him. He said, "Mr. President, I have no faith whatsoever in fiscal policy. These politicians can't get anything done. We've got runaway inflation here. I have to precipitate the worst recession since the Great Depression." And he went on and he did it. I mean, that took a brass pair of nostrils. I mean, there's no question about that. And once he flushed the inflation out of the system, look at the growth we had. But I have to say this to you, too. Most times, our stock market does pretty well. Here's Bernanke. Bernanke, since he came on board February 1st in 2006, it was a disinflation period. This is about 2 weeks old, so maybe it's a little bit less. The stock market's been negative since he's been there. But look at Greenspan and look at Volcker. I mean, those two guys was the greatest period of wealth creation. But the point I'm trying to leave you with here, when you have disinflation, you create wealth. But look at Eugene Meyer, never heard of him, and Eugene Black. Those poor guys were there right during the Great Depression. Well, Thomas McCabe is no relative to me whatsoever. But the point I'm trying to get to is William McKesney Martin. Remember, he was supposed to be the number one. What he did is he beat deflation with inflation, and the stock market went up. I think that's what you're going to see with the group of 20. Okay, now let's talk about quickly investing. We run a long-only index fund, a long-only mutual fund, and we are long-term investors. We think the key question you have to ask yourself is, how much can I afford to lose? We don't like the short-term performance derby at all. So if you're not going to be investors for 3 or 5 years, we say you probably could get a better money manager elsewhere. But if you believe in the American economy, what do we really know? After each recession, we go on to new heights. After each recession, the S&P goes on to new heights. So it becomes a game of valuation and picking the right stocks. But this is one of the worst periods in history, 20th century average annual S&P total return. Look at the 90s, 1910, 1920. Look at the 1930s, minus 6.3%, only negative period. So you do make money in equities over time. But look at what I have on the bottom here, 2000 to 2008, minus 1.6%. It's a little higher now because the stock market's up. So this has been the worst decade since the 1990s, that's for sure. Something else we have to keep our eye on is the capital gains and total return. I mean, I don't think people fully appreciate that when you have a debacle in the equity market, cash-rich companies have enough money to pay out dividends. And when you have a situation we have today where after tax, after inflation, there's no return on your money market, maybe some of these corporate behemoths that build or bury their competition in a recession are about ready to pick up. But maybe you're going to get paid 3 or 4% dividend yield while you're waiting for the multiple to expand, or you're waiting for the economy to come out of the bottom. But I think what's very crucial is this 15% tax rate on dividends. If you notice, the Obama administration is not talking about that. And one reason why they're not talking about that is because people need those dividends. So I thought the dividend tax would be raised, but I'm hearing some from friends in Washington, not at least for another 2 years. So that's really a plus. So if anybody's into total return, you can see where you have an opportunity to get some of America's finest companies at a low PE, and you're getting paid while you wait if you're a total return. We always say if you've got young children, put it in your 401k, or make sure you get them a Roth IRA, and make sure they dollar average. Because time, patience, the American capitalistic system, good security selection, that's how you create wealth over time. One question for you. What's the 4 ways in which you create wealth overnight? How do we do it? Marriott. That's number 1. Inherit it. That's number 2. Win it. Number 3. Steal it. Number 4. All right. We can't help you. Okay. All right. Let me give you one other one here. There's a 1-to-1 correlation between earnings per share growth and stock price improvement. But who wants to wait 5 years? Look at from 12/31/37 to 12/31/07. Earnings per share growth 6,680%. Annualized return 6.21. Look at the time frame for the price gain in the stock, same time frame, gain of 13,818%, 7.31%. It's almost a 1-to-1 correlation. If you reinvest the dividends, it's 11.38%. So that's what we try and tell people. Total return is very important. Another quickie, S&P 500, 1-year time periods without a gain, 71% of the time, 5-year annualized, 86% of the time. with a gain, 15-year periods, 100% of the time with a gain. I don't have the 10-year period. 10-year period is 99% of the time. Thank you very much.
Good job. Thank you very much.
Thank you.
Don't go away.
Okay. Oh, I'll answer any questions.
Yeah, do we have any questions? No questions. A question.
In reference to almost your last comment about believing in the American economy, if you're a long-term value-driven investor, what percentage of your portfolio is domestic-based versus international?
We are, in our portfolio, what we think is the right thing to do is have the large American multi-internationals. We don't want to take currency risk. We don't want to take foreign risk. So what we do is have the Johnson & Johnsons and people like that. Our way to play the foreign markets is to buy the larger cap stocks.
Mike.
Yes, with the current federal stimulus package and this $1 trillion in debt that the government has buried us in, where do you see us going forward? Basically, when is it time to pay the piper? Should we anticipate higher taxes, higher capital gains rates anytime soon?
I think a lot's going to depend on this meeting we're talking about in Pittsburgh. This is a global situation. I mean, you can't have the United States alone still being 22% of world GDP. So I think the pressure on us is going to be to demonstrate to the world around us that we can get our act together. I also believe, now this is just my belief, I can't, any media in the room? Okay. I believe that the only way you can prove to the world that the world is coming back and the United States is coming back is to have commodity inflation. So I think what the critical item now is to stimulate global growth, especially in those developing nations. If you look at those developing nations, what do they really have? They really only have commodities. So I think the Arabs are on our side by saying we're very satisfied with $70 oil, because you don't want to bury people with one or two commodities. But if you can get direct fixed investment in foreign lands and have joint ventures with G8 partners, that's one way of doing it. I think with the aging of the developing world and having so much wealth in the hands of people age 57 or above, we have to have a flip. We are a consumer-driven nation. Most of our trading partners are export-driven nations. We have to have them become consumer-driven while we become export-driven. What the United States really needs is a huge increase in young consumers with money in their pockets. And I think that's what we're trying to get out of these developing nations. As they become developed, think about the bonanza this could be for the G8. I mean, I know everybody talks about the BRIC nations and so on, but demographics is so important here. And I think the Brazilians are underestimating the amount of crude oil that they already have found. And I mean, all you have to do is take a look at what the oil service stocks are doing and what could continue to be done here. And I think one of the problems that we have with politics trumping economics, if there's one area where we could put a lot of people to work, is in the oil business.